why would an investor invest in this product?
Technically speaking, even if policy engine shuts down, your money is safe. From an investment or your capital perspective, there is still zero risk even if policy engine shuts down. We have done more than 100 crores of such investments already, and the active AUM is also roughly in that range. Around 2 lakh crore worth of policies get surrendered every year, and another 2 lakh crores is what is lying lapsed.
What kind of what numbers do you look at in terms of the returns?
I'm looking at doing volumes of close to 40,000 crores in a year.
Hi everyone, welcome to the Alt Investor Podcast. I'm your host Ankur, and today we have a very interesting guest on the show who's actually helping investors make money from insurance policies. Tarun Bahri, the founder and CEO of the Policy Exchange. Welcome to the show, Tarun.
Thank you, Ankur.
So, Tarun, why don't you tell me how you started this company, what was the motivation, and what's the business model like?
Sure. Ankur, first of all, I'd like to clarify, I didn't start the company. I joined the company now as a co-founder and CEO. What we solve in the company is actually, the inherent problem, which is lapsation. And largely, the reason for buying a life insurance is to get a insurance cover. But if you lapse your policy, naturally you don't get the cover. I think that's what we are really solving. But in turn, we are also able to create a product, an alternate product for people to invest in. Okay. And of course, third is insurance company, where we are helping them retain policies on their own.
So, Tarun, just help me understand, how does the entire process work? Say there is a policy holder at one end whose policy may be about to lapse, and then there is an investor at the other end. How does the investor make money from that insurance policy?
Look, what happens is in life insurance policies, they are largely a long-term contracts. Okay, and what we see, people are not able to sometimes foresee, the future, and while they have paid few premiums, they are not able to continue the policy. Okay, now this is the policyholder that comes to us. He is looking at exiting the policy, and we give this option to them that if you exit the policy completely, you will not get any insurance cover. So why don't you actually assign the policy to somebody else and continue to get a partial life cover? Okay, that's the solution to the policyholder given, and he gets the liquidity which he needs. Now, the products are also designed in a way that at the initial years, the value of the policy is generally lower than the premiums paid. Okay, because you want to encourage long-term investment. That's why the construct is like that. Now, once an investor is coming in, he is actually technically buying the policy at a discount, okay, and getting the full maturity, right? Plus, his investment period has also come down. Let's assume it was a 10-year policy, and this person, after 3 years, has said, I can't continue. So for investor, it's 7-year investment now, and plus he's getting a discount, and that's why the IRR improves, and he's able to invest it as an investment product. I'd like to clarify, for this investor, it's pure investment. There is no life insurance in this particular product for him.
Okay, so it becomes an interesting proposition though, because the original holder of the policy is still partially insured.
Yes.
And the investor at the other end makes some returns out of it.
Yes.
Okay. And what kind of what numbers do you look at in terms of the returns?
It's an alternate investment product, right? If I offer the same product or a return like an FD, I don't see they will take up. So we have a threshold that we have kept as an 8% minimum. Okay, so those are the only policies that get accepted and get offered or shown to an investor. The range is from 8 to 12. Now this can vary because of the underlying product and at what time this transaction is happening. So the range is around 8 to 12.
Okay, so why would an investor invest in this product over say a debt mutual fund or a fixed deposit?
Look, typically if you want to invest today in an FD, what will you get as a return? 7%. Now with the falling interest rates, I think the rates are even further going down. Similarly, on the debt side, if you go for a little higher return product, the risk is there, right? It'll be a paper which will not be that much safe. Now, we offer a product which is absolutely safe because ultimately it's the insurance company who's gonna, pay you that money back. And we offer the return which is at least 200 to 300 bips higher than those products. Hence, it becomes quite an attractive proposition for people to invest in.
Okay. So then what are the risks associated with the product?
Look, there is always risk associated. It'll be incorrect from my side to say there is no risk. But let's understand what are the risks. Uh, First of all, is the credit risk or the default risk. We know these policies are issued by the large insurers and they're governed through the IRDA and they have solvency risk. So the chances of an insurance company defaulting on the payment is very low. So the credit risk is really, really low. Okay. Then to me comes as an operational risk, okay, which basically means there can be an error committed in the operations process or a little delay from the insurance company when the payout is due. We ensure on the back end that this is also minimal because now as we are growing, those processes are being stitched out. So from that perspective as well, the risk is minimal. Okay. Then to me, the last risk remains as a regulatory risk. That to me, as per the current regulations, we are complying to all that is there. But having said that, if some regulations change, that risk remains. We know what happened with the gaming industry recently, but that's a risk we all live with, right? But as per the current regulations, we comply to all the regulations.
How about platform risk? Like tomorrow, for example, God forbid, if the policy exchange shuts down, how do investors get their money?
Absolutely. Look, first of all, you have to treat it as like a platform who's enabling the transaction. Okay. Once a policy is assigned to you, you become the customer of the insurance company. Technically speaking, even if policy exchange shuts down, your money is safe because it's with the insurance company, it's not with the policy exchange. Okay. But the way the business is growing, I'm quite sure we'll be there for long, and we want to grow this into a large business. As I said, from an investment or your capital perspective, there is still zero risk even if policy exchange shuts down.
So the way I see it, once the policy has been transferred, then there is no intervention needed from the policy exchange.
Yes and no. From a money perspective, there is no intervention needed, but we are here to serve our customers. We remain, or continue to interact with the customers from a servicing perspective. A simple example, you invested and now your maturity is due. So we help our investors get those maturities. But again saying, if I'm not there, it's not that you're not going to get the maturity. You can always go directly to the insurance company and get that money. Okay? But we today assist and give that services to our investors.
Okay, so Tarun, how are claims managed? Say if the person who was the original policyholder passes away, then how does it work and how is that entire process managed?
Sure. I think that's an interesting aspect to understand. And whenever we do such investments, I think every investor has that question in mind. Look, when this transaction happens or assignment happens, the life insured continues to be the same guy. Okay, and you are kind of the owner of the policy. Now, the arrangement is that whenever that happens, first of all, we help in ensuring that claim is processed. Second, the division of that sum assured is derived by a formula, which is part of the contract that you sign at time of the assignment. The larger concept there is that your investment, that means the money you have put in, plus the return that was committed to you, will be first paid out to you. And then whatever is the residual will go to the nominee of that life insured. I would like to talk about 2 death claims that we have already paid out. Okay, and that's where to me the real purpose of this particular business comes. This was a case where customer actually had 2 policies. He decided to assign one and didn't assign the other one. When he assigned, he got around 3.5 lakh rupees at the time of assignment because he had paid only, I think, 1 or 2 premiums. Now, unfortunately, this guy dies after 6 months, and the nominee was his young son, around 20 years old, right? Because that policy was assigned, the claim came up, and the claim was for of 20 lakh rupees. Now, since the investor had put in that 3.5 and he had paid the premiums as well, which were pending, despite that, that nominee got 13.5 lakh rupees at the time of the claim. And of course, investor got his money and the return back. Right? So everyone kind of got benefited. And to be very frank, looking at that 20-year-old, that 13.5 for him was like a lifesaver, right? So that's the positive aspect of this entire business.
So sounds very interesting. So how's the company doing in terms of how many users do you have? What revenues are you looking at? What AUM do you manage?
So we have almost touched from a policyholder perspective around 20,000 policyholders already. Okay, we have an investor database of almost touching 2,000 now. Okay, so that's on the side. We have done more than 100 crores of such investments already, and the active AUM is also roughly in that range because we have paid back our investors also. Okay, which also is a significant amount of around 20 crores. Okay, and there has been zero default on that payments.
Okay. So 20,000 policyholders and 1,000 investors is what you're saying. So
Around 2,000.
2,000 investors. So I don't see a 1-to-1 ratio here. So how does it work? Do investors invest in multiple policies or?
Absolutely. Because please understand, uh, the average ticket size is around 3 lakh rupees today. Okay, so once an investor comes and invests, they're looking at, say a much larger amount. So we also have investors who invested a crore plus. Naturally, they have then got more policies with them.
Okay. And any minimum ticket size that it's there?
Uh, Not really, but what we have seen is around 50,000 is the minimum amount that a person can invest.
Okay. Okay. And how do you go about doing tie-ups with the insurance players then?
Look, while this remains as a flagship product for us, what we also provide to our insurance companies is a complete retention services. Look, why would an insurance company come to me? Because they also have a core job of retaining their policies on their book. Okay? So what we do is reach out to them, advise them on the services we offer, and again, given my experience of managing this for large insurers, so we bring that up as a service, and this becomes another solution which today not many people offer, and hence the overall solution becomes an attractive solution for the insurance company, and that's why they're tying up. And just to answer, we currently work with 8 insurers already, and we are in very active discussion with at least 8 more to start the work.
Okay, so then you're helping the insurance company also maintain that number which
Absolutely.
they have to maintain for continuity.
Actually, this solution is one where every stakeholder gets benefited out of it. Okay, this question gets asked very often because generally somebody wins, somebody loses, but it's a win-win for everyone. Policyholder is getting money, getting a partial life cover. Investor is getting a decent return. Insurer is getting their policies to be retained on their books, and the distributor who originally sold the policy is getting renewal commission.
Oh, so he still continues to
Yeah,
get
he
the
continues to
commission.
get that. So to me, 4 stakeholders, everyone is getting benefited out of it.
Very interesting. Looks like that problem solution gap is plugged very well.
Exactly. And it's a very large gap in the industry. Today, the numbers, if I have to tell you, are rough. Around 2 lakh crore worth of policies get surrendered every year. Okay. And another 2 lakh crores is what is lying lapsed. Okay, so we're talking about a 4 lakh crore pool available, where you can go and help these policyholders. One, get, say some money out of it, and second, a cover. That to me is the most important thing.
Very interesting. So Tarun, how is the return taxed then?
Okay. It's very important to understand the taxation of these policies. In fact, we've taken enough legal opinion as well on this particular aspect. Now, there is a section called Section 1010D, which basically talks about in a very simple way that if your sum assured is 10 times of the premium, the policies fall under that particular regime for a tax assumption. Okay. Now, the taxation is different for ULIPs, unit linked plans, and for what is called a traditional plans. Okay. There also regulations have come in at different times. So,
By traditional, you mean endowment
yeah,
plans?
I mean endowment
Okay.
plans.
Yeah.
So ULIPs till 1st of February 21, policies issued before that are completely tax free, provided they comply to the 1010D rule of 10 times. So there is no tax on that. After 1st of Feb 21, if you are paying an annual premium of 2.5 lakhs or more, then it is taxed as long-term capital gains, which today is 12.5. Okay? The ULIPs, largely, if I have to say very simply, is LTCG. Okay? On the endowment side or traditional side, the taxation got changed in the April 23, the finance bill that came up. Any policy that's issued before that is completely tax-free. But after 1st of April 23, if your annual premium is less than 5 lakhs, it's tax-free. But if its annual premium is above 5 lakhs, then it's taxed at your marginal tax rate. That's all. A little complex, but we help our investors in terms of understanding what the taxation for the policy they are investing.
Got it. Understood. Okay, so Tarun, the recent GST and the tax changes that we saw, I mean, everybody's very happy. Insurance policies have gotten cheaper. So, how does that affect the business now?
Of course, it's going to impact positively, but I like to clarify a particular point there. Look, we largely deal with policies that are lapsed for some time. Okay, the GST change is going to be applicable for policies issued after 23rd or premiums falling after 23rd of September. But our investors have to pay future premiums as well. So your next future premium will have that benefit coming. Okay, but on the savings product, the GST is around 2.5%. So that's the benefit you will get. So if I have to calculate the net impact right now on the IRR, to me it will be around 40 to 50 bits that will come in. So you will start getting a 40 to 50 bits higher return, but only from future premiums paid after September 23rd.
Okay. And on an average, what's the number of future premiums that your typical user pays, or how many years does it take for that person to make the money back?
Look, it will vary from the underlying product, but what we have seen is, given it's still a new concept, people are still understanding. They have questions around it. The maximum investment period that we look at is around 5 years. Okay, there are few policies which kind of your premium payment term ends there and then income starts after it. So there can be a period where 10 years you're getting an income, but you don't have to pay. So that's the sweet spot we look at. One is you invest now and maybe 5 more.
Okay. So, okay, Tarun, what's your take on the industry? I mean, the policy exchange is just one company that I know of in this space. I don't think there is too much competition here. But how do you see the pre-owned policy market in India?
Look, it's at a nascent stage, but given the life insurance industry is growing, we have a very strong conviction that this industry will also grow and probably more players will also come in. Because if today 23 insurers are there, for pre-owned you at least need 5, okay, if not 23. That will come in, and to me the market will grow. I spoke about 4 lakh crores of the opportunity. Even if I have to take a very conservative number of around 20% of that, actually where policies get assigned, we're talking about an 80,000 crore market, right? So it's huge, and it's actually not possible for just one company to acquire that piece, because to be frank, it's about awareness as well, right? So to me, I actually look forward that some people would come in, which to me will only help bring awareness. As awareness comes, maybe this 80,000 crore can become whatever 1,60,000 crores also.
But isn't the barrier to entry quite high? Because the way I see it, partnering with an insurance company is not going to be easy, right?
Yeah.
So, isn't it a high barrier to entry to enter this kind of business?
I would say first mover advantage will always be there with us. But you can always enter. Look, all these large insurers are sitting on a very large pool, okay, of lapsation and surrenders. So if even one insurer has to tie up with two, three, to me, I don't see as a surprise. Even when I used to work, always when you have such tie-ups for retention, no, you never go with one. You have two or three. But yeah, first mover advantage, I think, will always be with us.
So, what's your vision for the company? What are you aiming for in the next 3 to 5 years?
As I said, solve the core problem. I want to be, as the market grows, first is to bring awareness, at least have 50% share in that market. So, if I have to talk about that, I'm looking at doing volumes of close to 40,000 crores in a year. So, that's what I'm looking at. And of course, having presence across, we remain an insurtech company. The focus on technology, AI, all that is going to be remain as a amount, because even today, all the process is today digitized. Okay, we don't do even a single physical paper transaction. Everything is digital from that perspective, and hence the confidence that this can be scaled up quickly is very high, and we are investing from that perspective. Just to let you know, we've raised funds very recently. We are now a well-funded company from that perspective, and the larger investment is going into technology and, of course, building the organization.
Great to hear. So, yeah, I mean, all in all, it looks like a very interesting proposition with a win-win for everybody. How do if an investor wants to invest, how do they start?
So very simple. To be very frank, we have a platform, thepolicyexchange.com. You just have to come, log in. It's a simple OTP-based process to log in. Do your KYC, and you have policies listed in front of you. You select. We will initiate the documentation. I said it's all digital, and if it's approved by the insurance company, because that process is important, you simply pay the money and policy is yours.
Great, Tarun. So it's like I said, it's a great proposition, and hope to see the company grow in the next few months and years. Thanks for
Thank you.
coming, Tarun. It was really great interacting with you, and hope to see you grow leaps and bounds.
Thank you very much. Thank you for hosting.
Thank you. Thank you for watching the Alt Investor podcast. If you like this content, do consider joining our community and subscribing to our newsletter. The link is in the pinned comments.